Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm your host, Mark Ainley, and with me as always is Tom Shellcross. Today we have an awesome episode because I get to do the introduction, and it is episode 200.
That sounded like Bigger Pockets. That was good. The Bigger Pockets music would come on right now.
Yeah, that was first cut too. I was actually nervous with so many people on the line here that we're gonna have to do that more than once. So I actually feel pretty invigorated right now. That was pretty cool.
Yeah, that's a good kickoff there. Congrats! It's our bicentennial.
Bicentennial.
Very Brandon Turner. I love it. It's good.
200 episodes. Like, yeah, Yumi set off here almost 3 years ago, and we said that our goal would be to get 200 people listening to each episode in 30 days. And we've blown past that. I mean, talk to me about some of these numbers we have. It's awesome.
Yeah, and so first off, thank you to everyone, and we're going to keep this thing going. This is not a goodbye by any means, but just the State of the Union. If we get 250 in the first 30 days, that was the goal. And I went back and looked at this because we have all the data. The first week, we got 466. So we doubled in the first week. So we got off to a pretty hot start. And now we're at about, anywhere from about $3,000 to $3,500 in a week. So about depending on how many Thursdays there are in a month, sometimes there's the fifth Thursday, which helps us. We're probably about, call it $13,000 for the month, right? So the goal is 250. So that's a good number, right?
Hey,
it's all how you want to, small to bigger pockets, but to what we set out to do, we're crushing it.
I am going to pat ourselves on the back for being for that type of numbers for the niche we are. Like, we literally have a call it 80-mile radius of coverage that we really try to be specific to. So anytime I tell people how niche we are, they're very impressed. So if we were at a nationwide level, maybe we'd have some things to strive for. But Yumi, our goal was to help people and add value to other people. And I think by those numbers, we're able to reach a lot of people, and that's very exciting.
Yeah, absolutely. And I think the most important thing is, I don't know about you, Mark, but I feel rejuvenated, right? We're not going through the motions. Like every week we're talking about how do we grow this thing. So I feel we still got a lot of room here.
Yeah. Oh yeah. The amount of value we could continue to add to people. And I think Yumi keep our creative juices definitely, since we met a few weeks ago, kind of doing our little annual plan for the year, have gone into overdrive for stuff that's kind of coming up ahead.
Absolutely. So I know we don't usually point the spotlight at ourselves, but it's our 200th episode, so we felt we get the 1.5 minutes to do so there.
Yeah. So
all right, so we're gonna get into this. Is a great episode. Before that, though, what's your housing provider tip of the week?
So my housing provider tip of the week is to start a podcast, get a following.
Great competition. Perfect.
Yep.
In all seriousness, anyone who is looking to start, feel free to reach out because we made a ton of mistakes. We can absolutely help there.
Yeah.
So today's episode going to be a little bit of a different format. We figured we'd do something special here. So we have not one, not two, but three guests on. So we have five guys on the Zoom screen here. It's a little crowded. But we're going to talk about, we kind of tried to figure out 5 or 6 questions that our listeners would want answers to. And we tried to look at the perspective from 3 different lenses, from the multifamily lens, from the 2 to 4 unit lens, and then from, call it, the single family 2 to 4 and all over the real estate landscape lens. So our guest today, we have Matt Field from Essex. Essex, a proud sponsor of the show. Thank you, Brian Kokendorfer, for the referral. We have Blake McCreight. Blake's been a longtime friend. He was episode 10, back the original gangster. He's been on multiple Tuesday tips since then. And then Jake Fugman, covering the 2 to 4 space, episode 20, and also multiple Tuesday tips since then.
So, and Blake's how we came together too. So we didn't even do that strategically, but Blake, you're the one that introduced me, Tom. So without you, heck, none of us would be on here right now.
Oh, that's awesome. So it's all coming full circle here, guys. So listeners, we're going to go through some questions specific to Chicago. We're going to talk about trends. We're going to talk about overrated neighborhoods. We're going to talk about underdeveloped neighborhoods. If you're interested in investing in Chicago, we're trying to hit on all those points here in the next hour with 3 folks who are crushing it, all in kind of different from a different lens here. So to get started, first question, and Matt, I'm going to let you kick it off here. Chicago has a lot of underdeveloped neighborhoods. It also has a lot of very, very stable neighborhoods. If someone came to you, gave you a $3 million check, and they said, hey, invest this in one Chicago neighborhood, don't lose money, give me a return, where would you park that money, and what would you buy?
Yeah, it's a good question.
Chicago is a city of neighborhoods, so there's a lot of good options. Every neighborhood has different pros and cons and various characters that make them unique. But personally speaking, I'm a big believer in Uptown and Edgewater for several reasons. They're the only neighborhoods north of Lakeview and Lincoln Park that haven't been as mature and stable for as long as those neighborhoods have. So you have more affordable product in those neighborhoods, but you're adjacent and you have the lakefront, you have the red line, you've got the public transit and all similar drivers that make Lakeview and Lincoln Park great neighborhoods to invest in. So the demand's pushing north. You get that spillover into Uptown. You get that spillover more so as yours continue to move on into Edgewater. And the quality of product that you can offer a renter for a more affordable price is there. You just get a higher quality apartment. The rents are affordable, and there's like 60-70% of the population there is renter based. So a lot of strong fundamentals there. And the things like adjacent to the lake and the outdoor space, the beaches, the greenery, all that stuff, it's there to stay. It's never going to move, and those neighborhoods will always be there. So if I was taking a long-term horizon, $3 million, I'd buy 10, 20 units in Uptown, Edgewater, close to the red line.
Got it. Matt, is it fair to say like the rent to price ratio, so the rent you receive for a 2-bed, 1-bath compared to the price per door is much favorable there than going south into Lakeview? Like the price per door definitely decreases, making it more affordable, but the rents don't decrease at the same velocity. Is that accurate?
Yeah, absolutely.
Cool. All right. Let's, Blake, I'm going to ask you, same question. I have $6 million. I gave Matt 3. I got another 3. What are you doing with my money?
Awesome. So do I get 6 million? Did you double down with me or?
No, you just got 3.
Oh, okay. I just got 3. All right, cool. I think I would go to a little different angle. I mean, I think I'd go to like East Garfield Park, between there and the West Loop. I feel like that's an area that's, the West Loop's growing and new businesses coming in and pushing out. And I think you can get good, in today's markets, you can still get good price points. They rent really well, good cash flow. Maybe today it might be a little bit more, maybe not the same as the north side of the city, but I think long term too, you're going to get appreciation over a long period of time. So that's somewhere I'm probably maybe a little more risk adverse. I think I'd put my money there.
You think there's a better opportunity there for appreciation with that play?
Well, I think you're betting on like what's going to happen between there and the West Loop as that market's pushing out and growing, and then you got Ukrainian Village that's been hot for a long period of time and pushing down. So like obviously the cash flow well today, but I also think long-term wise, you're probably going to get into it regentrifies, and I think you get good appreciation long-term.
Is there a street you wouldn't go west of?
What I would not go west of? That's a good question. Like once you get on
See, Blake's crazy though. Blake will go anywhere. Wrong.
Yeah, so you gotta remember, I'm like my primary, I wholesale a lot, right? So it's kind of for me, it's been on the aspect of I wholesale in all markets, right? It doesn't matter if it's a $10,000 house or if it's a $1 million house. So
East of the park, maybe then.
Yeah, east of the park is definitely like where I'd be at.
Cool. All right. So along those lines, another question here, and Jake, we'll let you lead off. Which Chicago neighborhood do you think has the best chance of having its housing price double from their current valuation? So I guess to rephrase another way, given where the prices are today, which neighborhood is going to be the first neighborhood to see that price double from where it is today? Who's going to have the next big pop?
Yeah, I mean, I'd say that there's a big difference, and it's a lot easier to go from $100,000 valuation to $200,000 valuation, right? So if you're trying to go from 500 to a million, for example, or cut that in half and go from, maybe where the single families are worth 200 to maybe where they're going to be worth 400 in the next 5 years, I'm kind of on the Blake train here because I want to be as close to the loop as possible on the west side without getting, too hairy. So, for me, I'm a fan of these areas on the near west side that have proximity just simply because of the proximity to downtown, right? Like East Garfield Park, the east side of Douglas Park, if you can be east of the park, they still call that Douglas Park, but you're, right along Western there. West Humboldt, but not, too far west, and, really the west side Ukrainian villages, because again, you're just so close to downtown, and we've already kind of see it happen. So if you're looking at places where proof is in the pudding, like East Garfield Park 5 years ago, semi decent two flats that were 250 are now 500. Like it's already there, and there's still room to grow. So I don't even transact a lot in East Garfield Park, but I still like that area. I'll also kind of add on to that as well, but just kind of shift down to the southwest side. We've seen so much growth in Pilsen, and I'm always pushing heart of Chicago and like the west side of what used to be called like heart of Italy and Marshall Square. I think those areas, they're not the prettiest ever to drive through, but proximity to the Pink Line, you shift that southwest side up to what would be the equivalent of the northwest side, and you're at Wicker Park. Wicker Park and the Pink Line, the California Pink Line are only about 25-minute L ride to the loop, right? So these are just, some obvious things that I look at which give these places just so much potential to just go through the roof.
I like it. What is and then maybe you don't know the answer to this. Is the city doing anything there? Like, is this part of some of those, Invest by Southwest, the TIF programs? Like, is any of that kind of subsidizing some of this growth here?
East Garfield Park getting a lot of attention, and it's not South by Southwest initiative from what I know, but they've dumped a lot of money into Garfield Park, the conservatory, and like things over there. There's been some startups in some of these warehouse spaces that were like adaptive reuse buildings. I don't know the exact addresses, but there was a lot of tax incentives given for people and businesses to kind of grow in some of those areas on the near west side, which still I think have room to go. I don't think there's a lot of money being dumped into Marshall Square, for example. There is some rumor and some talk about approval for a trail that would potentially connect Pilsen to Little Village along the train lines there. And the name's escaping me at the moment, but that's something I'm always kind of looking into because we spend a lot of time with multifamily deals in that kind of region. And if that happens, similar to the 606 and the Bloomingdale Trail, I think that would be enormous for the area. I don't see it being a negative at all. Connecting Pilsen to Little Village would, create a lot of positive flow, in my opinion.
The El Paseo is the trail down there.
There it is. Thanks, Mark.
Look at you. Good job.
Still very initial, and I think they talked about it, but it's not happening yet.
Got it. All right, Matt, same question. Where do you feel the next big pop's going to be in Chicago?
Yeah, it's a good question. I mean, I think Jake hit on a lot of stuff as far as what we'll see in the shortest period of time. A high level of appreciation. In my world, dealing with larger multifamily, it's harder to say. We do a lot of north side business. I spend most of my time in some of the neighborhoods that I had mentioned earlier. And, saying what's going to double in, a short period of time it's a difficult question to ask. But as far as just consistent, progressive, property increases of value and appreciation, consistently year over year, the neighborhoods that I mentioned earlier, Uptown and Edgewater, for example, even like Rogers Park and parts of Albany Park, Ravenswood, I mean, they're trading at cap rates that Lincoln Park and Lake used to trade when the cap rates in these further north neighborhoods were double, 300 points higher. So I think now with the amount of prospect for rent growth in those neighborhoods, when you factor that they're trading at 5.5 caps now, just like Lakeview and Lincoln Park, and you're looking at rents that are currently 15-20% lower than those adjacent neighborhoods. It's hard to say what would happen in a year's time or so, but over a reasonable period of time, the near midterm, I think those neighborhoods are going to continue to appreciate a lot because, in our world, a lot of our valuations, as opposed to single families or condos or small multi-residential, these deals are largely valued at, income and cap rate in a lot of ways, multiples of income, cap rate. And the per door, and that per door keeps rising quite a bit. So I think you're going to see a lot of steady increase there. It's not a big pop. I think Jake's right. I think those other, secondary markets in the city are more ripe for bigger, quicker appreciation. It's just not the world that I spend a lot of my time in. So I don't know as well.
we're talking a very optimistic tone here. And one thing I want to point out is not be a buzzkill, but East Garfield Park right now is almost exactly in the state Bronzeville was in 2007 before the market crash. Bronzeville didn't turn into what Bronzeville has in the last few years based on just the last few years. It was something that started in the back end of the last cycle. So anyone listening out there, Garfield, we don't know what's going to happen, and I don't think everything will ever drop like it did in 2008. But those type of edge areas are the first ones to slow down or even drop really quickly because all the speculation backs out. The people that probably maybe push the loans or got hard money loans are thrown in and stuff like that. If anything actually of serious consequence to the economy happens. So keep in mind, I agree with everything you guys are saying, but some of these edge neighborhoods, it truly turns into a long game. You want to make sure you're playing that long game.
Mark, if I can add to that, because it's a good point. In the last several years, because of how attractive Chicago's been to out-of-state investors, a lot of these folks, a lot of these buyers are raising money, they're syndicating deals, at least in the larger stuff that we typically sell, and they don't know the city as intimately as maybe some of the people on this panel or some of the people listening to this podcast that are Chicagoans. And on paper, a lot of these secondary and tertiary markets and neighborhoods in the city, they look great compared to everything else that's trading at 5 and 6 caps. You can get an 8, 9, 10 cap deal on paper, at least. It sounds great, and you're in Chicago on a macro level. But you're right. When the market turns, those tend to be the markets that do get hit first. And we've seen those markets for that exact reason. New Yorkers or people from California coming in, raising money. They're placing it in the South Side or some of these, other markets where they're getting these big on paper returns. And then what happens is the property values shoot up, but then we've seen those same properties trading in much shorter periods of time because those operators don't know how to manage and maintain, that product, as well as, the North Side is longer term holders. So properties don't trade hands as frequently. So I do think that same driver that is shooting up those property values could be the same thing that is, potentially just a risk factor that you want to be aware of before you place a lot of money in those deals.
And I'll just, before we move on, one more thing. A well-capitalized property, meaning you're not 110% into the value like a lot of people were in 2008, and a well-run property with smart management, or at least you're putting the right tenants in there, and you're doing that. If you can make it through a 3 or 4 year type low, and it still be a good investment, you come out the other side with these big gains. So I think it's just something to point on there. And a lot of these out-of-state people that don't understand like what you're saying are the ones that end up being victims, and you don't have to fall with them is I guess the point I'm trying to make if you run a good game.
Yeah, you nailed it, Mark. You guys nailed it dead on. You guys brought us on as experts, and then now when it crashes, we're going to be like the fools of the podcast when they depreciate, right?
But we can edit this thing out, don't worry.
Let's edit it. No, I'm kidding, but it is interesting. I think you nailed it with out-of-state investors. I mean, I think they have to be in it for the long term and have the right management in place and the right capital, because folks buying it 100% and no way, very small returns. It's a dicey game.
I just don't want us to sound like economists. No offense to economists, but I remember sitting and listening to the economist speeches in 2008, and then Lehman Brothers falls like 6 months later. But their forecast is like, it's fine and everything's healthy. So I want to make sure that we keep it real for our listeners.
I like it. So keeping it real, which Chicago neighborhood do you feel is currently the most overrated? Jake, start us off here.
Yeah, I mean, I think we can keep going on the same path as like which of some of the areas are being like almost too effectively marketed by some of these bigger mid-market brokers, right? Like a lot of these out-of-state buyers are coming in and buying things in what they think is Bronzeville or what's being labeled as Bronzeville when it's really not, right? So I think we're seeing stuff in Washington Park that is trading at a Bronzeville cap rate, and it makes me, cringe a little bit sometimes. So I'm a little worried about some of these multifamily buildings like south of 51st and west of the park that are being, traded at like $250 per unit, even when they're not, super updated. And maybe the cap rates make sense because the rents are being, are being paid down there. I just don't think people are underwriting the correct amount of like, expense and vacancy. So thus, I'm going to say the south part of Bronzeville, the fringe areas in that location are just a little bit too overhyped. And then I'm going to, a lot of my house hack clients and people that come to me that really are just clinging to the northwest side as much as they can. They don't want to open their eyes to, let's say, like Marshall Square or Pilsen or even the good parts of Bronzeville, right? So I'll also say that like the west side of Avondale, to me, when I talk to people that are like, let's find a 2 to 4 unit at Avondale, there's a huge difference being a couple blocks west of Milwaukee than being, east of Milwaukee or even Kedzie for that fact. Like once you get over that direction, you're in like Belmont Gardens, right? So I see a lot of people saying like, I found a good deal in Avondale, and I look at it and it's a 3 flat for, $675, and it's barely updated, and it's, still like a half a mile from, or even a mile from the train stop. So just being a little too gung-ho about just being on the northwest side in general, I like to rein people in just a little bit up there.
Yeah. So that's an area I like to play in. I agree with you. I haven't bought anything there in probably 18 months because even off market pricing is ridiculous. Like I think it's a fine area to own in, but like it's silly. I look at my comps, and when I go get an appraisal, and I'm very happy in that regards because I'm seeing comps that are just like, holy crap! Like how did this demand, 2 unit unfinished basement? Like how is that possibly $575? Like it just doesn't make sense to me. So it's great for the stuff I have there, and it's very hard to scale there because people are paying so high.
Get the same rents. Yeah, go to Portage Park a mile, or Belmont Craig a mile left, and get the same building for $450 and get the same rent, right? So,
and actually closer to the blue line, right? Like because the blue line goes on an angle. You're actually close. It's actually easier to get downtown, even though you're getting further away.
But use the income approach. I think up in those areas, I think where you get some of these overrated, neighborhoods, or when people start to focus on just the sales comp approach, it is still residential, right? So that's what lenders are going to use. But let's still look, realistically at what the rents are going to be. And if you can get the same amount of rent in a neighborhood that's similar, but, a little bit further away for $100,000 less, let's consider it.
Yeah, I like that answer. Blake, same question. What do you feel is overheated right now?
Cool. I'll take, as far as overheated, I think taking an approach from just like being in this business for 10, 12 years full time, especially for out-of-state investors or just knowing your area and market. I think getting into, the south side, right? The prices have really increased over the last 2 or 3 years. And I think if out-of-state investors coming in, they want to go in and buy in these markets because they look good and high returns. Back when I used to operate a turnkey business or help operate a turnkey business, that was always my concern, like on the management side of things. So I think really just from investors looking at it, like you got to come in and know the areas and understand, like right now that's the biggest area that's been probably at the biggest appreciation and values. But I still think seeing properties trade and like what's that going to look like in the next 12 months. And you just have to have the right team. It's more management intensive from a property management standpoint. I think a lot of times people think they can just come in and buy a property and rental. You just collect rent every month and it works, right? Like you have to really be able to manage the property management side and have a good team in place. So yeah, that's kind of my feedback on those areas. Yeah.
We'll go all the way around the horn on this one. Matt, what's overheated for you?
Yeah, another good question. It's kind of hard. I'm a big believer just personally. Part of this you got to take with a grain of salt because everybody's got their own unique perspective on what makes a good investment. And for me, I'm always surprised to see some of the stuff that trades in some of the western neighborhoods, like some stuff in West Town. Like they get these big rents for these small apartments, tiny bedrooms, and they're older vintage product, and they get the rents. There's the demand to support it. The values are high. For me personally, something doesn't check for me. Just to own it long term. They're historically good neighborhoods. They return well. The demand's there, but those markets to me it's hard for me to wrap my head around it when again you could buy something in a north side neighborhood at a a lower per door, get similar rents, and in my opinion, you get better product. And for me, I own some apartments too, and it's a big deal for me to feel like what I'm buying will not just be a flash in the pan product. It'll just always have renters that are going to want to live there, slightly bigger units, bigger bedroom sizes. And I think you just get less turnover with that kind of product. So it's a hard question. Everyone's got a different take on it. There's a lot of positive reasons why those are good neighbors to invest in. But for me, it never really made sense how the product out there for vintage units are trading in the low to mid 200 the door for what it is, right? So.
Well, before we go on, and I want to throw us off schedule, but Tom, like, what's your feedback on that? I love this question, and I'd love to hear what you think.
Oh, man. All right, so a couple things. I think
clearly not scripted. Clearly not.
Yeah, we could edit this though. I could sound better. So I think we missed, like, if you're currently buying in Pilsen, like, you missed the boat, right? Doesn't mean it's a bad investment. I do feel like it going back to kind of something Matt said, it kind of boggles me down there, like, when you have these like 8x9 bedrooms and everyone's paying the rent. Like, the numbers on the spreadsheet, they make sense, they work. It just kind of confuses me that, man, like, it just doesn't feel like, it doesn't feel right. But again, if the numbers are there. I'll also say, and this is someone, we just had Luke on, we're doing 2 projects in Logan Square right now. I am shocked at the values we get in Logan Square. Like, I am absolutely floored. For example, we did a deconversion in North Center, and at the same time had one in Logan. The one in Logan sold for 1.65. The one in North Center we flipped and we sold for 1.35. And, like, for me and my money, I'm living in the Coolney School District. I'm going to North Center. Like, it's just stable. Like, if you go down like that strip there on like Damon Irving, it's so awesome.
Yeah.
And like Logan Square get $300K more for that, right? Like, I guess I just undervalue just how much people want to live in Logan. And it's great. I mean, we're doing more jobs there. We're taking advantage of this, but it's one of those things that I just, personally, have a hard time wrapping my head around it, because I would go elsewhere. Jake, you're looking to say something. Jump in.
Wow. Yeah, I am. I was just thinking about Chinatown, right? And how, and the edge of Bridgeport there, where a lot of just the loyalty and like the desire to be in a very specific spot just pushes values up beyond what any real logical investor would ever spend on, multifamily, in my opinion. People like to flag certain parts of the Bridgeport, and again, Chinatown, and right along that, the river there almost. And I go through there and I just don't know what I'm missing. I'm like, how is someone paying what, you would get in maybe like an Old Town or even some of these, these areas, which, and again, nothing, the location is good, proximity to the city. But for me, it's a very specific area. And it just came to mind because I was there a couple weeks ago showing a place, and it was for someone that wasn't really from Chicago. They're from the suburbs, never been to it, but they flagged it. They wanted to check it out. And we were like, it went under contract in 3 days, and it shocked me. So the numbers just don't really pencil there.
Good question. I could talk about this one for a while. We got to move on. We got a lot to cover now. So, Blake, I'm going to turn over to you here. What are some local trends here to look out for in 2023, and maybe call it the next 3 to 5 years?
Yeah, I think something that I saw last year in the last 6 to 9 months, especially being pushed through like the RIAs and whatnot, Airbnbs. And like, I think Airbnb used to be thought of as more of a destination place or something you had to have. And I think investors are seeing success in normal neighborhoods. Meaning just like a regular neighborhood, you can rent out your place or room and the cash flow that you can get. And so I think my concern is like in the next 2 to 5 years, like, what does that look like? Is that going to become oversaturated as everyone starts buying these? And like, what does that look like? It's definitely like, as downtown has changed, I think people are traveling. They definitely like a place to live, stay versus a hotel. And obviously the amount rent you can collect is way better than what you're going to get on a long-term tenant. But when does that become oversaturated? And I think especially for newer investors that are jumping in and running their numbers. I mean, a lot of these new investors are like, okay, well, I can make all this money on a Airbnb, but what happens when that slows down or the city cracks down more on their restrictions and guidelines on the Airbnb side? So, seeing a trend on that side of the Airbnb. What's the, I'm doing it as well. I've kind of jumped in on some of these Airbnbs, but I also, with the known fact that we talked a little bit earlier, like well capitalized, right? Like, so I could cash flow it if I had to put a long-term tenant back in there, or hopefully we have, should be buying it with the right amount of equity that hopefully we could sell it if we had to as well. So those are something, something I'm noticing, and I think we got to be careful of as everyone jumps into that.
Man, how about this for a business model? I talked to a kid the other day, and he's probably 25, 28, something like that. But he's out here in the suburbs, and he literally bought a house down the street he bought it 3.5% down the street from his parents' house, lives in it all week, and then does Airbnb and gets like $2,400 every weekend. He just goes and sleeps at if he's not crashing one of his buddy's house, and he defaults back to his parents' house. But
That's awesome.
He's literally making all the, like, that's such a great way to get into and dip your feet into real estate. So
there you go. You also said he's 25, 28. I bet you he's like 35. Everyone just feels like they're 25 to us now.
I know. No, he's younger. He is.
So, all right, Matt, your answer. What are some trends to look out for here?
Yeah, I think bigger units, more open spaces. COVID, I think, was a catalyst for this. But actually, pre-COVID, I don't know if you guys paid attention or remember, but there was a period where building smaller units to get more density on a site was a little bit of a trend in housing. And I don't know if that's still absorbing as quickly or as high of demand as this is now, because I think being stuck at home through COVID, coming out of that cycle, the value that people place now on having a bigger, more open space that they can settle into for longer seems to be renting faster for more money and much higher demand. In addition to having outdoor space, anything that folks can do to buy properties that incorporates, you like a 1-bed plus den or a 2-bed, 2-bath with an office or something like that tends to rent really well. The bigger units are renting a little bit better than they used to, 3 beds, for example. And studios still rent as well, smaller ones. But I do think that right now there is just a lot of demand for these units in that kind of middle tier of larger ones with a den, or good size 2 with a spare room. And just because I think of the macro trend of more folks, there's just a deeper renter pool in general. Moving's expensive. It's inconvenient. It's tough. More people are just sort of accepting the fact that they are renters longer, and settling into a unit that you're familiar with, that you can call home. It's less transient if you have a space that allows people to do that. And we're seeing a lot of this product hit the market from developers just building a larger product. Rather than more units in one site, more density, they're just maximizing the space in the units themselves. Even if they end up with less, I think it's a safer play right now. You've just got more tenants.
Yeah, I even personally, I'm seeing that, the formal dining room, right? You have a 4-room apartment that's a 1-bed. A lot of times you go in there and make that a 2-bed. So you just have kitchen, living area, 2 bedrooms, no formal dining. And I think that 1 bed with the formal dining, it's back, right? You can demand a pretty high number on that thing.
And you'll still rent those smaller tubes, those 4-room tubes, they'll rent. There's a market for that, but it seems like it's more transient. You end up spending more turning units, you don't retain tenants as long. So we'll talk later about, kind of defining an investment strategy, kind of figure out who you are as a real estate investor. And, I think for me, for example, I like real estate that doesn't require as much of my full-time attention because I have other things to do.
Cool. Jake, anything to add here?
Yeah, real quick. On Matt's similar mindset, the 2 bathrooms, having that second bathroom and obviously bigger bedrooms help, but I'm seeing a disproportionate jump from like rents for 3.2s versus 3.1s, right? A 3.1 in a certain neighborhood that can rent for $1,500 is renting for $2,100 or $2,200 in the same neighborhood if it's got an extra bathroom, because it opens up and invites roommates, right? 3 roommates sharing a place, it's so much more realistic with the second bathroom. So watch out for that, and watch out for the, and I think a lot of these rent or build to rent buildings you see going up in Woodlawn and some of these, secondary markets you're seeing, all of them are 3.2s. No one's building really 2.1s, in my opinion, at least the ones that are selling. And I'll make a quick comment up in Airbnb as well as a lot of people can show the Airbnb income, and that's great. It's, Mark's example, that kid is crushing it likely, but no lender is going to look at the income approach, right? So a lot of these places, if you want to buy one that's already doing well, you're going to have to come in with cash or a higher loan to value ratio, because the appraisals just aren't going to match what that unit is making and maybe typically what those sellers want for those type of units. So just look out for the Airbnb income having, causing issues with appraisals.
That's a good point there. That's a good one. All right. Let's move on. Blake, we'll kick it off with you again. Biggest concerns for Chicagoland over the next 5 years?
Don, that's a great question, my friend. There's several ways to look at this, right? I mean, there's a macro, high level response, and I think it's obviously the crime, property taxes, jobs and jobs lost. And I think property taxes are always the forever ongoing concern in Illinois and the Chicago area. So, really looking at the cash flows today, and obviously rents have gone up. Obviously, can that sustain, and starting to level off, and what does that look like? And then you really also got to just jump into it from a micro level. There's so many submarkets. Chicago is so interesting. I think that's the hard part to come into this. Coming into Chicago, especially if you're not from here and trying to invest here, there's so many micro markets and submarkets within Chicago. So, you get the downtown that's obviously changing with higher crime. You got restaurants and things like that are closing. Where are these workers and that are going? Where are they being displaced to, and what kind of jobs are they taking, and where will they live, right? So I think that's the big question. What does that look like? So, but guys, we got to be bullish on Chicago. Maybe I'm overly optimistic, being the number 3 city in the world, right? Let's be honest. It has a whole lot to offer from the lake, museum arts. Obviously sports. We're still one of the best. I just think it's going to take, 3 to 5 years for the downtown and all that's happening with the crime, and getting a full picture, I guess, of what's really going to happen. It is Michigan Avenue is being, you have big shopping areas that are moving out, and those jobs are being displaced as well. So where are those people that are working? Are they, where are they going to, and what neighborhoods? So, but I think property taxes is probably going to be the continual topic as we move on into the next 3 to 5 years as a community.
Also, I was downtown today, man. It's here, right? It's right? So beautiful. There's tourists taking pictures everywhere, and all I was doing was trying to go to my dentist, right? And it's here, it's right here. We're here all day, and people flew in from all over to have this view, overlooking Wacker and looking into the river, and then looking east of the lake. It's man, it's right here. Matt, same question.
I think Blake nailed it. Perception is reality, and unfortunately, the headlines, the news, all the things that you read, on a macro level that paints Chicago the picture that it does. It's not true, but it is, I think, overplayed, especially when I'm sure you guys spend a lot of time in the neighborhoods. Chicago's a city of neighborhoods. These micro markets, these submarkets is what makes up the city. And it's what defines, the strength. The strength of a micro market is defined by the market you're investing in, not Chicago at large necessarily. All these factors do play together, but the things you read online and in the news, you have to take with a grain of salt. Understand they are real to an extent, but it's not as gloom and doom as people say. But outside of that is taxes. There's no way around it. It's the challenge we've always faced, and especially with Kagi and the new office, it's things are changing in that regard. People have been trying to wrap their heads around how to underwrite appropriately. And I think as big of a challenge as it is, to an extent, it's priced into our market. Our cap rates are higher than other comparable cities. You have, more margin. And, it's just something you gotta deal with. But no, Blake nailed it. I don't have much else to say.
All right. So Mark, you blindsided me earlier. I'm going to blindside you. What's your answer here?
Well, I think, anyone local has the advantage. Everyone from the outside or even the people from the inside that hear the headlines and follow that are not able to see the true opportunity here. And, we could look 100 years down the road, but anyone listening to this podcast, all you need is the next 20 years to make your fortune or create your life you want. And in the next 20 years, there's tons of opportunity. No matter what, here in Chicago was founded around the train and rail yards, and we have that. We have the industry, these 1 million square foot warehouses up and down all these highway corridors. We have these big airports that they continue to do $1 billion upgrades to. And we're the Midwest hub. Like, no matter what, our size. Tom, when you drove in down 90 today or down Elton or Milwaukee, that skyline, that view, there's not many cities in the entire world that are that big and that vast. And Milwaukee or Indianapolis or St. Louis, they're not going to be anything near that anytime in our lifetime, where we, no matter what, are going to be the default global Midwest city. Think about it just from a map standpoint. At if you look at all around the world, there's just these hubs around the world where people need to have business centers. And that's what Chicago is. No matter what you have pension problem-wise, crime-wise, all that stuff, well, those are all temporary things that get worked through and will go in up and down in phases. So that's my passionate answer to your question.
Oh, I love it. Yeah, I'll just piggyback on there and tie in the podcast. Like, go listen to the people who've been on here. The people who have made millions in this city and continue to do so every single day. This isn't foreign. Like, it's there. People are doing it every single day, doing it in different pockets, doing it with different strategies. There's a million ways to make money here. And so I think it's a cop-out to be like, oh, taxes, I'm going to go look elsewhere. And then that person who does that never goes and buys. Like, I never hear that person build a 100-unit portfolio in Indianapolis. Like, they just say, this isn't for me. They go look elsewhere. Then they go back to whatever they were doing. Like, it's a cop-out answer, I feel.
Yeah, just one more comment here, because if you really break down on a granular level, think about this. If you're starting off in real estate right now, you really need to do 20 or 30 good deals in the next 20 years. And maybe not even that many if you really do it strategically. So it's not like that's all you got to do is find 20 good deals. Like, that's it. For me, we always talk about the job market being so tight. It's like, all I need is one person for that position. I don't care about the rest of the market. There's that one person that is looking for a job that I just need to find that person. So if you really look at what you need for yourself versus the overall view of what people's perception is of an entire market entire thing that's going on, like, it's so granular that.
Love it. All right. We got to move on though. We got to get back to our schedule here. All right. For someone who's got just a little bit of money saved up, they want to jump into real estate. They've started listening to podcasts. They got the bug. What's the next tangible step? So a lot of people fall off. They get the education. They don't know what to do next. Matt, what would you tell that person?
Yeah, I mean, the first deal is the most important one, and it's the scariest one. And it's really important that before, you got a little money, before you get too excited and dive right in, you want to make a plan, right? And you want to find that sweet spot between, not overanalyzing and overthinking, but you do want to have an idea of who you want to be as an investor, what you want to accomplish through your investment journey. And, the first deal won't change your life, but it will sort of change your perspective or shape your perspective on what it means to invest in real estate. So there's a lot of avenues people can take. There's folks that work full-time jobs and want to invest passively. And there's syndications, there's people you can invest with, operators that you trust and you can put your money with that doesn't require a lot of hands-on experience or time invested. And that's a great route for the right person. There's also sort of part-time investors that can buy stuff that's maybe more turnkey, that also isn't as management intensive, but it still is something that you own personally. And that's great. For the right person, that's great. Maybe tighter returns is worth foregoing, maybe a couple % in cash flow for the ease of management. Or if you want to be a full-time investor, there's value-add opportunities. There's stuff where you can roll up your sleeves and really influence value. And that's great too. And the beauty about this business is there's really no one size fits all. But it is important to spend some time soul searching to figure out what you're trying to accomplish to invest in real estate and setting your expectations appropriately, that and you buy your first deal on it, again, won't change your life, but it might open your eyes to how it works. It might expose you enough to feel like you've built the confidence to do it again. And the guys that listen to your podcast, you guys are living proof of it. As you can't win a game that you're not playing, so you kind of you got to jump in, try to protect your downside as much as possible, and play a long-term game with some direction, based on, specify who you want to be in this game, what you want to accomplish with it. And then just say,
Good answer. Jake, you deal with, a lot of first-time investors, so I assume you get similar question. What would you piggyback onto Matt's answer?
Yeah, I would say after first conversations, a lot of the action items I recommend involve confirming what your financing options are. So talking to a lender, because there's a big difference between what someone might do with $50K with a house hacker and could put 3.5% down versus someone that needs to put 25% down on a pure investment property, right? So a lot of people don't know that far ahead of this is going to require 30% down based on, the debt to service ratio or whatever the case might be. So in addition to connecting with like a broker or just a mentor, someone who's done this, before you, talk to them, see what they did. And then again, a lot of times I'm pointing people in the direction of, hey, before you get a search started, before you start talking about neighborhoods, before you start talking about 2-unit, 3-unit, 4-unit, whatever, understand how much you're going to put down and then work backwards, right? How much do you have? What does that equate to in regards to budget? Then talk to someone and say, okay, here's my budget. Here's how much I'm going to put down. What neighborhoods have inventory with this, right? And then I like to go that route versus just kind of having having some blinders on and being like, I want to buy in Ukrainian Village, has to be Greystone. It's like, okay, well, let's talk about why.
Yeah, because Greystones are awesome. So Blake, you get a lot of people too, right? Because you're all over the map. You have high end stuff. You also have people can buy properties for $30,000 off you. What do you say to that first time guy who comes in and you might be like, hey, he's coming in eyes wide open. What's your advice?
Yeah, I mean, ditto what Matt and Jake said in a lot of ways. I mean, the thing of it is, get your first deal done. You're running your own race, so don't worry about how quick or slow it takes to get it done. Sometimes we benchmark ourselves against others, and there's really nobody else to compare ourselves or compete with in this business besides us. And then just a couple of, some things I would say. I mean, what do you want from real estate? Is it cash flow? You're trying to flip? Like, what is it that you want? How much time? Very similar to what these guys were saying. And then also, I think try and do it like in your local market, like maybe your local neighborhoods if you can. I mean, why? Sometimes I think we want to be, I heard, Tom is crushing it in the north side of the city in these neighborhoods, so I want to go there. And I don't know anything about those markets or street specific stuff or the nuances of different neighborhoods, where I probably know a lot about where I live, or at least have a good idea. I've been here for 10 years, right? Or wherever you've been at. So I think try to stay in that local area and not try and get outside your box. And also don't take on a huge rehab. I mean, why? I see a lot of new people take on these full gut redevelopments and they just get their, I guess we're being recorded, so their butts handed to them, right? So, I mean, it's a big challenge. So those are a few things that I recommend to new people. And then the last thing is once you know that neighborhood you're going to be in, find that mentor, find that person that you could go and that's buying or doing a lot there, and how can you help serve them? And then in return, learn from them, because they'll probably be able to get some good deals and figure out the things you didn't know.
Yeah, Mark always says, steal a team, right? Go ahead and steal our team. There's a lot of people out there that can help you. So, guys, this has been absolutely fantastic. We're not doing a wrap-up just because we have 3 of you on here, but we're going to ask one question as the wrap-up question. We'll go around the horn and let each one of you answer it. So, Jake, I'm looking at you, so I'll let you start. If you were running this podcast, what would you do differently?
Oh, that's tough. In Proof in the Pudding, you guys have an awesome following, and again, I'm super grateful to be on here in the limited group that's been on 2 times. So very exciting. Again, not to copy Bigger Pockets or anything like that, but I like to talk to people about like real deals, right? And people do bring up numbers. You get some success stories, and and maybe some failures. And I think there's an awesome mix of that. I want people to see like what's trading currently, right? Like what deals have people done this week? What are the random? What have they submitted? And maybe filtered a little bit, but that's something I like to put out to some of my clients. They're like real deals that traded this week that sold in these neighborhoods. Brokers have their pulse on that a lot. They're seeing a lot of stuff get closed. They're following these, Instagrams. But maybe, I like just raw data on what sold in what neighborhood. So I'm like, oh wow, I didn't really think something could sell for $650 on Grand in, Chicago, for instance. So
That's crazy, by the way. But no, that I love that idea. And we've actually put out to listeners, we'd like to do more of these deal deep dives. That's been one of the goals here. And you see some of the current episodes that aired right before this and after this, where I think Mark and I both wholeheartedly agree with that. So, all right, let's Matt, kick it over to you.
Well, I think it's obvious, Tom. If I were to do one thing differently, I have, again, because I'm having a blast. And I'm the only one on this podcast that hasn't been on before. I'm kidding. But no, this is great. I've had a blast. And I do think what would be cool is more in person. Like if you guys did an episode with an in-person energy, everybody's in the same room, chopping through ideas. It's so much fun. And I think the before and after of the podcast is cool because I get to, hear a little bit more personally about each one of you guys. There's so much to learn just being in the same room with other people, and, doing it on Zoom is awesome, and in person would be fun too.
I like it. Blake, what do you got to add?
All right, guys. Hey, I know one of the things you mentioned at the start of the show is you guys want to help people and add value, which is, I commend you guys. You guys have done a great job on putting this together and continuing to add value. And, for those that don't know what it takes, I know the tip of the week was let's add start a podcast, right? But the truth is you guys put a lot of time and effort and have a team to edit this and make it all work. So hats off to what you've done and put together. And I know you're doing it for probably out of your own pocketbook. So I'm just going to help you out here. One thing I would change is how can you monetize it? Seriously,
You're like the top landlord. We're pretty bad at this.
So, but plug yourselves, right? Like Mark, you have a property management company that hopefully this is helping feed investors into, and obviously, Tom, you would love to have some Northside properties sent your way and helped out. So, I just think to help give yourselves a little credit and a plug for yourselves every once in a while to make sure you're monetizing this, what you're doing, because it's funny. I've been in this community for 12 years full time, and every new episode I'm like, wow, I didn't know these guys, I didn't know that person. You guys just keep pulling out like people I didn't even know, which is really cool. Yeah. So appreciate what you're doing.
Well, I love it. I love all the answers, but I think Blake's is the best though. Let's make some money. So guys, this has been awesome. We end with the Chicago fact. Mark, are we 200th episode? Are we playing for someone?
Oh, we are, and this is double. So being actually not double, it's 200. We're gonna, instead of the $50 gift card, Brianna Fitzel is.
You couldn't figure out because it wasn't double or triple, so you couldn't figure out what the actual percentage was.
Yeah, so Brianna Fitzel out of looks like Logan. We're gonna play for a $200 gift card. So that's.
So you guys can take the cop out here because it is multiple choice, and I'll choose one of each, but don't do that. Choose what your gut shot says here. All right. So 200 episodes. We have about it's the questions to be about the podcast. We have about 250,000 downloads, predominantly in the U.S. So majority of those are coming from here in the States. There are several countries outside the U.S. where we have, call it, 500 to 1,000 downloads. Given it's the 200th episode, which country is closest to having exactly 200 downloads? So in theory, in my head, there's one guy sitting there and he's downloading one episode and he's the only one in that country listening. So your options are Brazil, France, Italy, Australia. Mark, you first, and we'll go around the horn.
Italy.
Okay. Blake?
Brazil.
Matt?
Australia.
Jake?
I mean, you're gonna make me play the numbers for this for this guest, so I'll say France.
Ah, you guys did. Hey, guess what? Mark got it right. Italy.
Oh, really?
Yeah.
Oh, nice.
Nice work, Mark. For those curious, the second most downloads outside of the U.S. is Mexico. So
All right.
thanks,
Thank
for
you, Javier. Javier runs.
Javier doing 200 of them.
Javier runs around to every all his neighbors' houses and downloads. He gets his downloads in Mexico. So thank you very much, Javier. All right, Brandon Fitzel, thank you so much. You purchased a Straight Up Chicago Investor shirt on the merch store on straightupchicagoinvestor.com. Thank you. You also now get a $200 gift card, and I feel a little more real
Showing
that
out money.
I picked it versus just kind of us play the numbers. So it's legit, Brianna. And if you don't feel that way, then either way, you still win. So, man, Matt, Blake, Jake, like what a great show. Tom, thank you for 200 episodes. Listeners, thank you for 200 episodes. We want to keep providing value. Things that we could use feedback from you guys on is other people that you think could be great guests to add value. Jake said it here today, deals. If you want to come on here and let us dissect your deal for the good and for the bad, I think people learn more even from the bad. So if you're able to be humble enough to come on here and vulnerable enough to do it, we'd love to have you on here. So lots of new things coming to the website. Right now, this show will air in a couple weeks, so it'll be still in advance of our 200th episode party that we're having on March 9th. So hopefully tickets are still available by the time you listen to this. If not, reach out to, if you go on there, it's sold out, reach out to us. Maybe we can squeeze you in, but more than likely, buy them sooner than later. So guys, Jake, Matt, Blake, thank you so much. Tom, thank you as always. Listeners, thank you so much, and we'll see you next week.
Thanks all.